class, we are going to discuss about futures contract. And our discussion will start with distinguishing between a future contract and a forward contract. Okay. Now, let's look at the difference between futures and forward. In our class on forward, we have learned that forward happens as a private contract between two individuals or two institutions, and there is no such stock market or secondary market for the forward contract. Primarily, that is the basic difference between a future and a forward. See, we often had heard about F&O markets. That is referring to futures and option market, where we have an active secondary market, right? So we will distinguish on the basis of trading place, quantity, margin, or conditions that have been laid down by stock market for ensuring the transparency as well as the performance of the contracts that's been set in these markets. So the first is, as we already said, the futures happen through stock markets, whereas forwards, it happens as the contract between private parties. So accordingly, what happens here is the regulations, the conditions are set up by stock market with respect to futures, whereas in case of forward, it can be customized. That's why we say the quantity traded, we say that as lot size. The quantity that is to be traded per contract is decided by the stock market in case of futures, whereas in case of contract, that is customized. It depends on the need and demand of the parties entering into the contract. Now, one of the greatest risk which we said about a forward contract is the risk of default in payment, default by any one of the parties, maybe the person in the long position or maybe in the short position. But that is taken out in a futures market through something called as margin money. If somebody would like to enter into a futures market, they really have to deposit a margin money that is decided by the exchange on the basis of value of the underlying asset. So that person or that institution has to deposit certain amount of money that is decided on the basis of the value of the underlying asset at the time of entering into a contract. In case of forward, no such mandatory requirements are there. If needed, the parties can maintain such, but no such mandatory requirements are needed or enforced by any regulatory body. So in case of the plus point of margin is, suppose if there is a default by either any one of the party, the loss to the other party will be set off through this margin money. That's how the exchange facilitates the conduct of these transactions in the secondary market. So that is little more safer for the parties who enter into a contract. And later we will talk about this, the concept of mark-to-market margin conditions and all later in our discussion. But currently we will keep like this. There is a margin requirement with respect to the futures, but that is absent in case of forward. Settlement, of course, in case of forward, since there is an absence of secondary market, normally settlement happens at the end of the contract period. Even though some parties, they go with settlement upon mutual decision, but generally that happens at the end of the contract period, maybe after 3 months or 4 months or 10 months, dependent on or as decided by the contract. But when we are talking about the futures market, there is a concept called daily settlement. That is, every day your asset, the settlement is done like following the principle of mark to market, that is considering the changes in the value of asset brought in by that day's transactions in the stock market. So that is why we say that it's daily settlement. Even though the final settlement is done on the closure, there is a daily settlement that is arranged with by making adjustments in the margin money. So that is why we say that there is on a daily basis, it is being evaluated with respect to what is the change in the asset and what step to be taken to minimize the risk exposure to both the parties. So that is why we say that there is something called as daily settlement. Now, regulation, we have said there is a stock market, since that happens in the stock exchange, all the regulators who are looking after the affairs, who are regulating, managing the stock exchanges in India would be managing the affairs of futures market also. So that's why SEBI will act as a regulator. Companies law will act as Companies Act will act as a regulatory bodies. So that regulations, whatever been applicable to the companies which are set up in India, as well as the stock market regulations that has been put forth by SEBI, Security Exchange Board of India, from time to time will be equally applicable to futures and options market. Now, the closure, with respect to closure, we said the closure can happen easily even before the final settlement date. The reason is you have a secondary market with respect to futures. But in case of forward, that is pretty difficult because you do not have a secondary market. And the settlement happens through clearing house. That is, in case of futures or as a case of options, which we are yet to learn, the buyer, the person in the long position and the person in the short position will not be having direct contact. They will not meet each other. They will not contact each other. Actually, the communication happens through the clearing house that is put forth by the stock market, stock exchanges. So the point of contact for the buyer as well as the seller would be clearing house. It is clearing house which takes care of the daily settlement as well as final settlement of this contract. But that does not happen with respect to forward. Individuals, they formulate the contract, they enter into an agreement, they settle it themselves. There is a direct contact between the individuals. That is why I put over the counter. Direct contact between the parties. Who go with the transaction. So these are the primary difference that happens between futures and a forward. These differences are because futures are traded in a stock exchange depending upon the type of the asset. Say if it is with respect to stock, if it is with respect to index or interest, that can be traded in a stock exchange, like National Stock Exchange, or as you say, Bombay Stock Exchange. But if it is with respect, the underlying asset is a commodity, definitely it will be taken to the commodity stock exchanges in the country, multi-commodity exchange or any other commodity exchange that is within the country. So the settlement definitely happens through a clearing house. So prior settlement, that is before the maturity date also, the settlement is possible with respect to future contract. So these are the primary difference between a future and a forward contract. Now moving ahead, the functions of futures market. Yes, the primary function as every derivative markets takes care of is hedging. Say for example, suppose if I am a jewelry manufacturer, say, that's very easy for you to understand, that's why I'm telling. Suppose if I would like to possess 10 kgs of gold, taking an order from a wedding group for delivery of some ornaments after 6 months. I want 10 kg of gold for meeting my order. So definitely, I expect that there can be a fluctuation in the gold price. Now, I am in need of gold in 10 months. So, but in 10 months period, I expect that there is a change in the gold price. So what I can do is I can enter into a contract with somebody who has a opposite expectation that gold price is going to decrease. Right? So I enter into a contract for delivery of, in this case, he or she might be preferring physical asset. delivery physical asset, because he need gold for making or he need gold for making the ornaments. Or sometimes he may not prefer that, because if you go with physical assets, he will have to bear the carrying cost also. So accordingly, the forward price will be little higher because it includes the carrying cost. So sometimes he go for the cash settlement where ownership of the asset is not needed. So he will hedge against the rise in the price of the gold, and the other party who is having a different opinion will also hedge against the price fall in the gold price. So the difference, if this particular jewelry owner gains as he expected, if the price went down, and the other person lose if the price went up or price increased. So that is hedging. You are transferring the risk due to fluctuation in price. That is the primary function. Of course, there are a lot of speculations. In fact, when you look from the perspective of India, most of it, rather than going for hedging, most of it happens due to speculation, planned speculation. Most of it is happening in that way. But some of the developed markets, they are hugely benefited because of this hedging option or hedging facility provided by futures market. So that hedging, or as you say, transfer of risk of, here in this case, mainly risk of increase or decrease in the price of the underlying asset. Then the next is price discovery, because we say that yesterday we learned that the theory, expectation theory, say that the future spot price is reflected through the forward or derivative price, maybe forward contract price or future contract price. So that happens. That is, if the most of the consumers or most of the investors are expecting a bullish market, automatically there will be a bullish trend that is exhibited in every financial instrument that is traded in the market, in the financial market. So that is, it helps in price discovery based on the demand and supply. That again is another function, because it's a secondary market, and it helps in natural flow of demand and supply. So automatically that will help in price discovery of a financial asset. And financing, that is another important role performed by the futures market. That is especially that is very true with respect to agriculture or commodities market, because agriculture sector finds it very difficult to get financing before the harvest. But actually after harvest, immediately, or in certain cases before harvesting itself, they have to start with the process of next cycle. So they really find it very difficult to get the fund for starting the next process. So a futures commodity market or option market can help the people like that to fund to get enough finance to go with their activities, to proceed with their economic activities. That is another function that is being done by futures market. That is, they can enter into a futures market for selling their agriculture produce, even when it is ready for sale, even before the harvest. They can enter into, because they expect that the harvesting is going to happen after 3 months. So the price is going to be like this, and they enter into that. So that is a genuine transaction for financing their products, right? So that can happen, and more infrastructure developments, other development can happen when there is no shortage of funds. So that again is another function of futures market. Then liquidity, of course, when you consider with the forward market, liquidity is much higher with respect to futures market due to the factor that it has an active secondary market. So that again is another function that is rendered by the futures market. Price stabilization, or as you say, a control, a curb on the volatility in the market. The futures market or stock exchanges, that is same with respect to any stock market transactions. A steep fall or rise in the price of a security is controlled by the stock market to a natural phenomenon. Normally, if there is no rise of, it depends on the asset category, but if there is a rise of more than 10 to 15% in the price of an asset, exchange normally stops the sale or purchase of that asset for the day. So that is, it helps in like normalizing the condition within the stock market, like short-term fluctuations and all, which is due to excessive speculative activity. And this disseminating, the next important thing is disseminating information is based on the transparency the market offers, because now at any time I can log into NSE market and just see what is the price of no, maybe HUL's futures, or I can look at the futures of any asset and see how price movements are going on. I need not wait for 10 days or 20 days to get the information. It's very transparent, right? So that is, it helps in disseminating the information regarding the price movement of financial assets. That again is another function that is served by futures market. So these are some of the functions that is performed by futures market. Now we are going forward. Some of the terminologies which might appear similar with what we had discussed in forward, but of course there is slight difference in certain terms which are not there in forward market, because it is customized market. One is spot price, it remains same, the price of the asset, which is prevailing in the market at the time of entering into a contract, spot price. The price of the underlying asset. So for example, if I'm going to purchase Nifty futures, okay, the spot price is the rate at which Nifty is trading now. Suppose if it is going with 15,260, I don't know exactly, I'm just guessing, 15,260, that's it. Okay, that's the spot price. Now future prices, at what price the contract being entered into, what is the price promised at the end of 3 months or 6 months, that is future price, futures price. Contract cycle is a period, so how long you have entered, is it for 3 months, is it for 1 month, is it for 2 months, that's actually the period. Expiry date is, if I'm talking about normally in NSE, every contract, every contract that expires in the last Thursday of the month. If it is 3 months, last Thursday of the month of the third month. If it is if it is 1 month, last Thursday of that particular month. Say for example, if I'm talking about June, that you can see if you just log into NSE. So likewise, expiry date is the final settlement date for a contract price. Okay, that is what we call as the expiry date. Contract size, that's what we say as standardized. In forward, there is no such condition. Suppose if I want to have 1,000 shares of HUL, another person would like to have 10,000 shares of HUL, that's possible. But in I will show that in the NSE side, but in standardized stock exchanges, here there is something called as lot size. They will specify what is the minimum amount which you have, minimum lot size with which you have to enter. So in stock market and all, generally for futures, if you have to enter, looking into the lot size, it might take like 2 lakh or 2,50,000 for entering into that. It's expensive, right, for purchasing the lot size. But there is another benefit. You can take risk. You can without actual ownership of the asset, you can just enter into trading through investment of margin money. Maybe see if the total contract is 2 lakh, I might have to invest only 3,000 or 4,000 to enter into a long position or short position. And then according to the change in the asset, I just have to, underlying asset, I just have to increase or decrease my margin money. So that is possible. But if I really have to buy or become owner of a contract, there is a lot size number specified. So I cannot just specify that I need a futures contract with 10,000 Infosys share, or maybe 5,000 HUL. I really have to look into the market, what is the lot size for that, and then I have to go with the trade. So that's what lot size, the contract size what is the exact amount will be specified. It varies from asset class to asset, and basically it is somewhere dependent on the value of the asset. Okay, then basis is the spread. It's actually the difference between the future price and the future spot price. It talks whether I am in a profit or loss. So that is spread. When, as you call, no, interest income and interest expense for bank. Likewise, here it is the difference between future price and future spot price. What is the price at which the asset is trading at the expiry date? That's what we call as basis. Okay. Then initial margin, I have already said, if I have to enter into a futures market, I really have to deposit margin money, which is calculated on the basis of a certain percentage of the value of our asset. The next is marking to market is every day. See, in morning, if I look, maybe Nifty is trading at 15,250. But by the end of the settlement day, it might become 15,700. NSE index. So that change will have to be reflected in my margin, because when NSE is 15,700, the value of the underlying asset increase. Accordingly, my margin also needs to be increased. How much is it? That will be specified by our broker. We cannot directly trade, no, as it happens in stock market, we cannot directly purchase and sell assets from the, as you call, from the stock market. We can do that only through our brokers, or as we call as our intermediaries. So they will specify, okay, this is the margin money which you have to maintain to proceed for the next day. That's it. So these are some of the terminologies which mean we need to be very sure with when you're going with the futures. Okay. Now concepts. Listen to me very carefully, because these are the things that are going to guide our understanding of pricing of futures. Okay, very carefully, very, very carefully. Now concepts, buyer, the long position. When it is said long position, it talks about buyer. Same as a forward. Seller, it is referred to as short position. Okay, when I'm saying A is in short position, it is that he has promised to sell some asset. His contract is for selling the underlying asset. So that's why short position. Trading volume, when I'm talking, that same with respect to stock market also, as we said when we were discussing about securities. Trading volume, it deals with number of trades in one day. Say, trading volume can be for the whole market, or it can be for particular asset category. I can say what is the trading volume for commodity futures, or I can say what is the trading volume for paper futures, or for currency futures, or for INR US future currency futures. I can say. So total number of transactions that has happened, or trades that has happened in one day. That's what we call as trading volume. Then open interest is those, there are certain terms which we will learn when we are learning option, like in the money, out of the money, at the money, all these, which we are leaving it for the time being. That's not there. But open interest is total number of contracts that are outstanding. That is, that are yet to be settled. It's not over. Say, for example, at the end in NSE, if you look up, by the end of last Thursday of the month, okay, last Thursday of the month, many contracts expired. Any contracts expired, which might have been 1 month or 10 months or maybe 3 months, but the expiry date was last Thursday of June. So that is not open contract. Those that are still traded, who are still not expired, are called as open interest. That's why I put the total number of contracts outstanding to be settled. It can be settled today, or it can be settled at the date of maturity. It depends on the parties. So if you want to settle, what you can do is you can settle it and exit out of the market. Right, so that's it. So open interest is those contracts that are outstanding. Then settlement price, it is the price before the final bell. Say that this is applicable with respect to daily settlement. Daily settlement, okay? But if I'm talking about final settlement, it tells me the final future price at which the contract be entered into. But if I'm talking about a settlement price on a daily basis, okay, what is the future price as on particular day by the end of 4 o'clock? What is the price? What is the final price it is staying at? It is open to purchase. That will be the settlement price. Okay, that is the final. And what you have to remember is once no, it is once it is the future price is fixed, that's not going to change. Only the value of the underlying asset is going to change. Okay. So settlement will be decided on the basis of change in the value of the asset. So, for example, if I'm talking about Reliance share, maybe I have entered into a future price with 600 rupees. Okay, 600 rupees to be settled in a 1 month period. So the time period for that is 1 month. Okay, for NSE it will be, if it is 1 month means the last Thursday of this month, June, last Thursday of June. So if it is like that, what happens here is if the underlying asset, if Reliance price have gone from at the time of entering into contract, if the spot price of Reliance was 500, okay, but today after few days from my entering into a contract, after few days, the price of Reliance became say 550. Okay, it increased from 500 to 550. Right. I have gone with settlement with 600 rupees. Okay. So if both the parties agree, you can exit at that moment by settling between the long and short position. If you have agreed to purchase that at 600 rupees, okay, maybe within 1 month, if it has gone above 600, the buyer is going to have a long position. I mean, the buyer or the person in the long position is going to gain. But if it has gone below 600, okay, the buyer is going to lose, because he has agreed to purchase the share of Reliance, which is trading at 550 for 600 rupees. So he is going to lose. So that is why we say that the settlement price depends upon the price of the underlying asset. Okay, so it can be whatever the price prevailing as soon as the stock market ends. The price at the ending period of a day's transaction. That's what we call a settlement price. Then daily price limit, that I have already said. What is the limit for change in the daily price of a particular asset? If it avoids steep increase or steep fall in a asset price. So if it is normal, that is allowed to change accordingly. But if there is a steep fall or steep rise because of some market information, normally it is kept as 10%, depending upon the volatility of the asset. But 10 to 15%. If it is above that, the trading of that asset is stopped for the day. So that is what we call as daily price limit. Okay, so these are the concepts. I just repeat once more. We are talking about buyer who would be having the long position, the seller who is called as a short position. Trading volume is the actual number of trades that has happened in a particular day. Open interest is those contracts that are still open, that are still active, that's not expired, all that will be open interest. Settlement price, basically it depends upon the movement in the value of the underlying asset, and an increase or decrease in that will alter the price that is to be if it is cash payment, it will decide what is the amount to be paid to the person in the long position or the short position. Daily price limit, it controls the steep price or fall in the movement of the futures price. Now, settlement of futures, as I told, primarily it can be cash settlement or physical settlement. And when we are talking about final settlement, that's where we talk about the cash settlement, either by paying the difference that has occurred because of the movement of the underlying asset, or it can be by delivery of the physical asset. Say, for example, if I promise to deliver 10 kgs of gold, what I will do is I will just deliver 10 kgs of gold. If it happens to futures, at the time of me entering into the contract itself, with respect to metal and all, I have to make it available in the warehouse specified by the stock exchange. But if it is agriculture products and all, before the expiry, before the final settlement date, I have to ensure that the asset is, the commodity is delivered to the specified warehouse. That is what I have to ensure it. And then physical asset is delivered to the party by the exchange itself, by the designated body. And when we are talking about the cash settlement, the difference in the spot and the future price is transferred to the concerned party. That is it. Then there is another mark to market. At the end of each day, when we are talking about futures, we have to accommodate that. We have to make the difference, the relative difference in the margin money. That is something through which we are covering the risk of both the parties. So if there is a steep increase in the value of underlying asset, maybe the person who has agreed to purchase that will have to go with the margin money. Will have to increase the margin money because the value of asset has increased. Right. So that's it. It is decided by the clearing house itself, which is communicated through the broker, and the broker will be intimating the customer, the concerned investor. Okay. So two types. Basically, final settlement will happen through physical or cash settlement. And when you look into actual practices, mark to market on a daily basis is done by adjusting the margin money, and final settlement at the closing of your last trading day of the future contract. So suppose normally that happens in that way only. That's why I said, no, for NSE and all, they take care of last Thursday of the month, and if last Thursday is a holiday, immediately after that, the working day, immediately after that. That's how they normally decide. Now, listen to me. This is very important. This is what I had been trying to explain. Now, I'm just exhibiting a diagram for explaining that. Payoff for a buyer of futures if he is in a long buyer. So that is long position, right? Suppose. Okay, so suppose imagine that Nifty is standing at 15,220 at the time of entering into a contract. Okay, now for a buyer, 15,220, and if it comes to 15,500, he is making profit. The person in the long position, if the price increases from 15,220 to 15,500, he is going to gain. Why? He is getting an asset at 15,220, which carries, this is at the settlement date, okay, payoff. That's why I'm telling at the settlement, final settlement date. In between, many things can happen. It can increase or decrease, whatever. But finally, what is the position? That's what we are talking about, the payoff for buyers of futures. So finally, on the settlement date, if the price of the underlying asset is standing at 15, here the underlying asset is Nifty index. NSE index, NSE 50 index. Okay, so it is standing at 15,500. So this party benefits. Why? The benefits would be computed as 15,500 minus 15,220. He benefits because immediately he can sell this asset at 15,500 if he is taking the physical position. If he is just taking the cash settlement, he will be given with the remaining amount by the person who has taken the short position. That's seller. This happens, but the reverse will happen if he entered into a contract. The Nifty was trading at 15,220, but during the settlement date, if it came to 15,000, this person is going to lose. The person in long position, final settlement date, if it is coming to 15,000, he is going to lose. Why? Because he is purchasing an asset for 15,220. Nifty, the underlying asset, is currently trading at 15,000. So he is actually paying 15,220 for an asset which is whose value, the underlying value is 15,000. So the difference will be settled to the person in the short position. It will be given to the seller, because otherwise he could have just withdrawn from this and sold to the market the same asset at 15,000. No, if it is suppose the buyer he could trade this asset at a higher price in the market. He could have waited for that, but he expected that the trade is going to show a bearish trend, so he entered into this contract. He supported the price with 1520. So the difference between 15,220 and 15,000 will be given to the person with the short position at the time of final settlement of the asset. I repeat once more, suppose if on the final settlement date, okay, during the day of entry into, say, imagine the day of entry into a contract is June 1st, okay. June 1st, Nifty, the underlying asset is Nifty, which is trading at 15,220. Okay, but the contract was for 1 month. So in next month, July 3rd, if this person is going with the final settlement and he finds that Nifty is trading at 15,500, the person in the long position gains. The difference will have to be set off by the person in the short position. The difference between 15,500 and 15,220. But that's not the case when on April 1st, if it was 15,220, and on the final settlement date, that is on July 3rd, the asset value is 15,000, which means the price came down. So this person has to buy the asset at 15,220, which he could have got at 15,000. So the difference of this is actually the gain of the seller, the person with the short position. The difference will have to be paid to the party, to the concerned party. That is, here in this case, it is person with the short position. So this is with respect to payoff for a person in the long position. Now, the same can be explained with respect to payoff for a person in the short position. Now, a person in the short position is somebody who has agreed to sell the underlying asset at a certain price. Right. Now, for him, now what you have to understand here is, for him, at that time of entry is 15,220. Let's keep June 1st itself, 15,220, and it's a 1 month thing. So by July 1st, this person finds that, okay, if the price is 15,500, for him it is a loss. Why? Because he is compelled to sell an asset at 15,500, where he was looking into that aspect where he has agreed to sell that at 15,220. So the net payoff here would be for it. But what you have to understand here is right price. Okay, the future price depends upon the spot price and many other factors. So during that time, this person expected that the price is going to fall. That was his expectation. But market went against his expectation and the price increased, which means it was favorable for the person who took the long position. So that can happen. This is your expectation. You expected many factors and you said, oh yeah, the market is going to have a fall. Maybe you expected that here now people are suffering because of COVID-19 and all. So the share price normally should go down. But unfortunately, now the market is performing well. That's the true thing that is happening now. Now the market is performing extraordinarily well. If you look into the stock market, you can find that. Which means a lot of people lost their expectation. They expected that the market is going to fall and they entered into short position. But actually the people who entered into long position are gaining now. So if that happens, what happens here is you're going to lose money. And that money, that the difference will be your loss, which will be paid off to the concerned party. Okay. And maybe when we are looking at the opposite, okay, sometimes you entered into the position with 15,220, selling the underlying asset at 15,220, okay, you entered into that. And what happened here is the market went down, So you have a gain of 220 per share. How much ever is the lot? Maybe the market lot is 1,000. So it can be 220 into 1,000. You're going to gain that much. If the market lot is 10, you're going to go with 220 into 10. Easily in a period of 1 month. That's the charm of this market. If you can gain, you gain it in lump sum. Because here you just checked the underlying asset was Nifty. So now the people who expected an increase in Nifty is gaining like that. They entered in saying that the Nifty is currently 15,000. The market is going to go up to 15,500. So they have been looking into if it is underlying asset is 1, they are going to 1 unit, they are going to gain by 220, 500. But if it is 10, you imagine 500 into 10. If it is 100, you imagine what is it. So that's the kind of gain that can happen to people in the derivative market. At the same time, there is equal loss also. You don't know how the asset is going to move. So that is actually little risky also. It can move in any direction. So your risk exposure is unlimited. That is again another problem with the derivative market. People who are very disciplined with respect to financial matters only can enter into derivative market. Otherwise, you will incur huge loss, maybe total loss of your money. Right. But if you are a person who can take up planned investment, watching the market, you can gain much return from this, even in 1 month or 2 months. Your average return can be more than 20 to 25%, where in other sorts of investment, what you can expect is maximum of 8 to 10%. That's a gap, right? And the period for gaining this return is comparatively lower. So that's why we say that. Now there is one concept which you really have to, which I'll show you, which you have to understand is, now we were explaining with the concept of 1 unit. 1 unit of Nifty. If 1 unit of Nifty was 15,220 at the time of entry, it became 15,500. This is the gain. 15,500 minus 15,220 for the long position. But if it is 1 unit, 15,220, and it reached 15,000, that's a profit for the person with the short position. So that is actually the difference between that. But normally in a future price, there will be lot size. The future price is decided on how many units are there. We are just explaining with 1 unit, but actual future price can include a lot size of maybe 1,000 or 10,000 or 20,000. That's a deciding factor. But it is very easy for us to understand if we explain with one unit of underlying asset. So if 1 has a profit of 220, and if you have 1,000 in that, 220 into 1,000. That's actually the spread of your profit with respect to the futures. Okay, so that's how we go with the short position. So what you have to understand is, a person in short position in a future market will benefit if the market falls in. If it is a bearish market, a person in long position in a futures market will benefit if the market is bullish in trend. Bullish, because he wants to get, and he expects that market is going to increase. So he fixes a price below that. Suppose currently the spot price of Reliance is 430. This particular person expects that market is bearish, bullish. The Reliance price is going to reach up to 550. So he's fixing that I'm going to buy that at 500. And suppose he can get that at 450. Okay. He can get that at 500. And suppose if the market reaches this 500 or above that, 500, he has no profit, no gain. But above that, 550 or maybe 600 or 700, he gains. With every unit of increase from that, he is going to gain. Because he is getting an asset with a particular value whose spot value is more than that. That is actually the benefit or payoff as you talk from a futures market. Now, the theory of future pricing is more or less similar with the previous forward theory, cost of carry approach, where it's saying that there is an interlink, Keynes and Hicks. Most of the theories are propounded, initial theories are propounded by Keynes, Hicks, and as we say, Calido. And what we are talking about is the first cost of carry approach. He says that there is an interrelationship between the spot and future prices, reflecting the carrying cost. That is, the future price would be more if the carrying cost is high. It's very natural. If I am incurring 80,000 for carrying the asset for next 3 months, I will add that also along with the forward price. I mean, in this case, future price. Same as the case, if I expect the carrying cost to be 1 lakh, so naturally my future prices would be little higher than the 80,000 carrying cost, than the one with the 80,000 carrying cost. So that's what we say, that there is an interrelationship between the carrying cost and the future price. Okay, so it will be future price plus the same formula which we learned, future price plus, spot price plus carrying cost will be reflective of our future price. And that's where we said about the arbitrary opportunity. That's the theory price. If the actual market is trading above or below, that is, if the asset is undervalued or overvalued, there is scope for speculation. Arbitrageurs will come into, and arbitrage opportunities will exist in the market. So that is something called as cost of carry approach. Expectation approaches, again, the same thing. The future price is dependent on the expectation of the investors regarding the future spot market. That's why it talks about how or what will be the asset price movements in future. So that's why it says that we can predict the future spot market by looking into the future price. Okay, because they say that if the investors are expecting a bearish market, the future prices would be high. If the investors are expecting a bullish market, if the investors are expecting a bullish market, the future prices would be high, and it happens in the reverse way. That is, if they are expecting a fall or in the future spot market, automatically the future, as you say, prices would be less bearish. So that is where you can look into, you can learn about the future spot market by looking into the future prices. That is what we call as expectation approach. And the theory of normal backwardation is something different. When it is the reverse, it does not happen in that way. Normally, what we say is the future prices are higher than the future spot price. Okay, normally that happens. Future prices higher than the expected future spot price. That is what the normal market says. But when it is just the reverse, when the future prices are below the expected future spot prices, that theory is called as normal backwardation, backward. It's not the real situation what is expected. That is, your future prices is below the future spot price. Normally what we say, future prices would be above the future expected spot price, and that's what we call as basis. But when it is in the reverse order, that comes as what we call theory of the theory of normal backwardation. And contango is again the ideal condition when future prices are more than the future spot prices. It's just the opposite of normal backwardation. Contango is it talks about the normal condition where future prices are higher than the future spot price. So there are primarily 3 theories: cost and carry, where we say that future prices will be a reflection of spot plus carrying cost. Then expectation approach talks about the investor can know about the future spot price looking at the forward prices, because it is primarily the expectation. The forward prices reflect, the future prices reflect primarily the expectation of the investors. So if they are expecting a bullish market, the future prices will be higher. bullish market in the future spot, then that accordingly will be reflected in the future prices. And theory of normal backwardation is just the opposite, where we talk about future prices are comparatively lesser than the expected. There are many other factors that leads to maybe a high level of speculation, maybe the actual future prices are away from the theoretical price arrived at. Maybe many reasons are there, but the net result is future price is lower than the expected spot price. And conductor is the ideal condition where future prices are more than the expected future. So these are some of the theories, and we will take a short break. We will stop here. So, I'll just have a recap of what we had been discussing. In our today's class, we were discussing about futures market, and we started with discussing about the distinction between forward and a future market. The primary difference between a forward and a future market is a future market happens through stock market platform. So that's why it's very much standardized, and it has its own rules and regulations which are fixed by the stock exchanges along with the support of the regulators. Then we spoke about how the settlement happens in a future market. It is pretty difficult. It is pretty different from how it happens in a forward market with respect to a concept called mark to market, because daily settlement happens in a future market since we have a platform. Since we have a platform for operating. A stock exchange, a secondary market, a very active secondary market. So that happens with, and that is reflected in the value of the underlying asset. So that's why on a daily basis, based on the changes in the value of the underlying asset, it is being adjusted. Right? And of course, since it is happening through a stock exchange, there is genuine security offered through the investors through a concept called margin. That is, if you have to enter into dealing with the futures trade or future contract, you have to initially start with the margin money, and that needs to be maintained on a daily basis based on your risk exposure. Right? Then finally, we discussed about some of the theories, which is cost of carry approach, expectation theory, as well as the normal backwardation theory, which is against the wave, which talks where the future prices below the future spot price. That's not a normal condition. There are many factors that will lead to such a condition. Maybe the price is far away from the theoretical price, but it is a condition where your future prices are below the future forward prices, future spot prices. And contago is a situation where we say that future prices are above the future spot prices. That's it. We stop here.